Good afternoon. Today is Friday, June the 9th. The time right now in Hong Kong is 1:45 in the afternoon because I just checked in, so this recording is a little bit delayed. And let's recap what happened overnight on Wall Street. Basically, we have the release of the weekly jobless claim, and this time the market was surprised that there was a marked increase in the number of Americans claiming unemployment benefit. For the market expectation of 235,000 to 261,000, an increase of 28,000. So this is actually a 2.5 years high in terms of American claiming unemployment benefits. So we can see that going into this the month itself, we can see that the labor market is beginning to show sign of slowing down, meaning to say that there are going to be more unemployment. We can see that last week on the non-farm payroll, we can see that although there were uh, quite a significant amount of people being employed, but we also saw the unemployment rate jump from 3.4% to 3.7%, which is rather significant. So this week, jobless claims reaffirm the situation in which Americans are beginning to lose job, and this I think will be music to the ear for the Federal Reserve, because the entire reason for hiking interest rate as aggressively as they did since last March is to basically see evident that the job market is being destroyed. Why would they want to do that? Because the reasoning is very simple. As far as the Federal Reserve is concerned, if less Americans are employed, that means to say there will be less consumption, and that could be one way to bring down the inflation. So this is actually what we are seeing right now. 14 months after the start of a very aggressive rate hike by the Federal Reserve. So right now, what we are seeing here in the equity markets, we see that equity market actually went up overnight, and we have the 4 hours time frame went up higher to the highest point so far for the week itself at 33,873.8, and whether this will be enough to cap the current run. Because what happened also at the beginning of the week is that we all know over the weekend, the US debt ceiling had a deal, and on the very first day, on Monday, the US Treasury went ahead and started to issue an insane amount of treasuries to the tune of 359 $259 billion, bringing the new debt that the US is accumulating to a record high. So this amount of debt being issued, meaning to say that it is taking liquidity from the marketplace. Now, don't forget that on top of this, we have the Federal Reserve still at the quantitative tightening phase, in which they are also drawing liquidity away from the market. So in combination, we have a massive amount of liquidity that's leaving the market that will inevitably have an impact, I would say negative impact, on equity markets. So the upside potential for equities this round is getting seriously limited. So for those who are still holding on to buy position, you want to be extremely careful. In the Dow Jones, at the very most, the market may actually go up no more than 34,080 to 34,500. This is actually the max I will see the market extending as far as the Dow Jones is concerned. So be very, very careful. But if we have a a situation in which this actually panned out, where the market actually went up to 34,000 to 34,500 and then struggle and then come back down, the immediate target I would think will be somewhere around the 33,000 levels. So there's going to be quite a fair bit of a drop, more than maybe 1,000 to 1,500 points, depending where it picks. So just be very careful going into this weekend. In the S&P 500, we saw the market actually struggle to go to a new high for the year. So far, the high was only the day before yesterday's high was 4,299.20, and it is on the upper end of this range. But the market currently is within an area in which I do believe it is vulnerable to selling pressure, and that area is 4,268.6 to 4,307.5. Again, you can say that the market has been struggling of late, and I would bet that it is going to come off rather than go up any more higher, because upside we have a a key point here in terms of the last August high of 4,325.3. So again, whether it will actually challenge that level remains to be seen. But I think the odds are beginning to shift to the downside. Again, you want to be very careful. Over the Nasdaq, this is about the only index of the three that has beginning to show sign of wariness. The high traded for the year so far is 14,663, and we can see that the day before yesterday, the market actually came off rather significantly, although it bounced back, but this bounce is only 50% of its entire drop based on Wednesday trading activity. So again, this area, like I say, is also vulnerable to selling pressure. Is 14,136, 14,136 to 14,712. And once the market do close below the last April high, which is a 14,277, that could be the most glaring example, or rather confirmation that the market is probably going to come off. So there will be quite a bit of profit taking, and if that cascade into an all-out sell, then this market may actually go down and test the May low at somewhere just below 13,000. So there's going to be quite a fair bit of a drop here. So do be very, very, very careful chasing this market ever higher. Over in Asia, we can see that Nikkei is already struggling. The high traded on Tuesday, on Tuesday, correct? No, it's on Wednesday. It's at 32,708.5, and then you can see yesterday market came off, and now it is bouncing back. Now this bounce back is only about 62%. Currently, the market is within this bracket. Again, that may actually invite some selling interest here. 32,216 to 32,430. So this area, let's see whether it can actually cap this run. And so long as 32,708 remains where it is, there is more. This market may actually be more vulnerable to the downside. Immediate target will be 30,560, which is where the last bottom is. Over in Hong Kong, we can see the market continue to edge higher. We have a marginal high for the week itself. Currently at midday, we can see that Hong Kong equity market has actually rebounded. Let me see where the high is at the moment. Is 19,463.6, not far away from this pivot point which I have mentioned throughout the week at 19,452. 454.6. So we are not that far away. So we can no, sorry, that level should be my bad. That level is 19,521. So like I say, this pivot point is going to be crucial. Let's see whether the market can actually close above this level. If it cannot, then of course the implication is that the market may actually unravel when next week. Over in China, we can see the mainland equity market in terms of the CSI 300, which is a major equity index reflecting the blue chips within the Chinese equity markets. We can see that it is struggling. The market is, although hit a bottom here, which technically can be concluded as a double bottom. This bottom is at 3,777.78, and but so far the rebound has been very, very tentative, with no sign that it is going to rush higher. Immediate barrier to higher prices, in my opinion, is 3,866.7, and then let's see what really happens here. Over in energy markets, we can see that energy yesterday have a bit of a hoo-ha here. Market was on the way up before it came back down to trade to a low of $69, and this is on the back of new development as far as the US-Iran deal is concerned. Apparently, US has been negotiating with Iran to allow it to export crude oil on condition that they actually curtail their nuclear program. So apparently, there seems to be some kind of a update. They're not sure whether a deal has been struck, and if it's so, it may actually cancel out this week's announcement that the Saudi Arabia, the largest oil producer, is going to cut production by 1 million barrels per day, because the new deal, if it happens with Iran, between the US and Iran, is to allow Iran to export 1 million barrel a day. So how nice, the number just cancel out each other. So let's see what happens on this front here. If there's going to be a deal, then obviously the advantage that we saw as the price firms up on the back of the weekend news update that Saudi Arabia is going to cut production by another $1 million, 1 million barrels per day, may actually negate the entire rally here. But based on technical, I still believe that the upside is still quite viable. In fact, I do see an extension of this rally here from a low of $67.01 towards maybe perhaps the $77 to $78. This could be something that we will probably see over the next couple of trading days into next week. Over in precious metal market, we can see that gold prices has actually rebounded, but it remains in consolidation within a price range of just under $1,970 to a low so far about $1,940. So between this $30-40 range, the market has been trading sideways, but if today we get a bit of a pullback to somewhere around 1,952 to $1,955, that could offer a short-term buying opportunity for a challenge of the $1,990 to perhaps $2,000. So again, this is basically trading sideways. So because it will grind and grind, so if you have no exposure to this particular asset class, maybe it's a time to step aside, allow the market to grind until it comes to a resolution as to whether it wants to trade higher or lower. Okay, but over in the silver market, we can get a sense that the silver market remains very, very firm. We can say the market has been going up, and over the short term, I do believe there is a little bit more upside available in this silver rally here. Immediate targets about $24.60 to $24.90. So do watch out for an extension of this rally. Last night high is, this morning high or rather is at $24.36. So maybe there's a little bit more to the upside, but again, this is just a three-wave rally. So do watch out for the idea that the market may actually be capped between $24.60 to $24.90. Over in the currency market, we can see that the dollar actually came off last night. Again, this is nothing surprise because I've been talking about this three-wave pullback from 104.62 in the dollar index, and this may actually see the dollar index trading a lower towards the 103, perhaps the 102.50 levels, and that could actually provide a buying opportunity because I do believe the entire rally in May from 152 to 104.62 is incomplete. There will be an extension of this rally. So going forward, I do believe the dollar has a lot more upside to offer than what we have seen so far. In the major currency pair, we can see that the euro versus the dollar is exactly a mirror image of what we saw in the dollar index. As the dollar pullback, of course, the euro rebounded. So again, this is very similar. We see a three-wave rally, whereas we are seeing a three-wave pullback in the dollar index. So in the euro dollar, we can see the top side is also quite limited. I don't believe it's is able to hang on to its gain. At most, I will say 108 to 108.50 levels, and this will present a selling opportunity. Because when we look at Europe, yesterday news is that the entire Eurozone has slipped into a recession just days after Germany slipped into a recession. So when Europe and the whole entire Eurozone has slipped into recession, obviously the currency will not be able to remain strong. So the fundamental is behind the idea that maybe we should be looking for selling opportunity rather than to buy this dip. In sterling, we have a more pronounced rebound, and you can see that the rebound from 123 all the way to 125.45 is probably incomplete. It does appear that it is unfolding in a three-wave rally, very much similar to what we saw in the euro dollar, just a lot more pronounced. Top side is going to be limited, in my opinion, because the next economy to slip into recession is most likely to be the UK, and of course, that being the case, the same reasoning for not buying euro is the same reasoning why we would not be buying sterling. I would believe that if market can struggle all the way to 126 to 126.60, that offers an excellent selling opportunity. So do look out for that possible extension of this current rally. Over in the Aussie market, again, this market is behaving in such a way that I also believe that the upside is quite limited, despite the Reserve Bank of Australia having raised interest rates when the market is not expecting one. The Aussie has only managed to rise, only not spectacular. Based on previous example, if we have a central bank that unexpectedly high interest rate, that should cause a more pronounced rally in the currency. But right now we are seeing an extension of this rally, but it is nowhere near spectacular. Top side, I would believe, is 0.6760 to 0.6780, and that should offer the top side for this current round. Okay. Over in the dollar versus Canadian, we can see dollar Canadian has been falling like crazy, and it is the most significant fall just when the dollar is beginning to pull to correct. So this pullback from 136.55 is a little bit more pronounced in the dollar versus Canadian, because we all have to understand Canadian dollars is highly correlated to the price of energy. That means crude oil. So if crude oil prices started to recover, it will take on it will also cause a corresponding rise in the Canadian dollar. So when you look at dollar versus Canadian, that means the dollar is coming down relative to the Canadian dollar. So we have seen so far the low is at 132, so 133.20, which is not that far away from the May low at 133.15. So the market right now is on the lower end of this move. If we get a bounce, the most we can expect is 134.85 to 133.25. So again, this is a little bit far-fetched from where we are right now. We are looking at a possible 100 to 200 pips move into the upside. Based on current sentiment, it may not come through, at least for now. Okay, so maybe you should watch and not try to do anything in this currency pair here. Now, the one that has actually been quite a bit of a disappointment is the dollar versus the yen. I have shorted this pair, but the market doesn't seem to want to go down significantly. Although we do see the market coming back down overnight to a low of 138.75, but the market does appear to be trying to go back up again. So again, this barrier of prices between 140 to 140.20 again looks like an area of selling opportunity. The most we can expect right now, I have to be more realistic. If I get to see a price that extend below 138.40 to possibly 138.90, 137.90, I'm going to call it a day, take my profit, and just be happy that I have come out alive. Okay, so basically the money is not in dollar yen, obviously, for now. Now in the cryptocurrency space, we can see that there's been quite a bit of volatility this week, largely due to the news that the US Security Commission has actually sued the largest crypto exchange, which is Binance, and its founder and chairman, CZ Chow. And the other one was following just 24 hours later, the SEC has also sued the largest crypto exchange in the United States called Coinbase. So by and large, we can see that the market has actually behaved rather differently when the two news are when the two lawsuits are filed back to back. Okay, first, the reaction to the first lawsuit against Binance caused Bitcoin prices to fall from 27,450 all the way just below the 25,400 levels. Then on the second lawsuit, which follows within 24 hours after the first, the market did not really collapse. In fact, it only went down marginally to a new low for the week at 25,350. And then we saw a sudden surge back to $27,400, which is exactly where it was before the first lawsuit was filed. So that caused a little bit of confusion. And since then, the market has come back down to 26,140, which actually meet a immediate pocket of buying interest. Let's see whether this buying area between 26,000 can actually hold the market. Now, the reason why we have a counterintuitive rise in the Bitcoin prices on the news of the second lawsuit largely can be attributed to the fact that players and market makers are starting to shift their holdings in Binance and Coinbase to other exchanges, which caused the premium in other exchanges to spike. Okay, it's rather a significant spike in the premium between the price of Bitcoin quoted in Binance and Coinbase relative to the other exchanges. So this is actually working out very well for the other exchanges that are not based in the United States. So this temporary move in Bitcoin prices may not be sustainable, but again, let's see what happens. If the market is a little bit unsure as to how to react, because the SEC suing crypto exchanges is nothing new. Remember, Ripple Lab has been sued by SEC for more than a year now, and to date they still could not take them to court, and the judge may not actually rule in the SEC favor, because this is backward looking. They are looking at a retrospective law. They say that all these exchanges that are operating in the United States are offering tokens and coins when they do not have a license to offer security. So they are calling all these tokens and coins being issued over the years as security, and the rules are not clear. And obviously the argument is that since there's no rule that specifically mentioned that coins and tokens are considered to be securities, why do they now want to sue them and retrospectively claim that those were securities? So this is going to be something that we will want to watch, not necessarily that the Security Commission will actually win, but in my opinion, this is no accident, because next month on July the 4th, the US is going to launch a very similar system called FedNow. Now, FedNow is not a cryptocurrencies, but it is a digital payment that allows Americans individually as well as corporation to open account directly with the central banks instead of opening their account with traditional banks in which they can make their payment. Okay, so this is not cryptocurrencies, it is more akin to a CBDC, which is a central bank digital currency. This is not decentralized, and it is definitely not transparent. So there you have it. I wish you guys having a great weekend for the coming days. In the meantime, I will be going back to Singapore tomorrow, and I shall see you next Monday. Bye bye. Take care.